Welcome into CrushTheStreet.com. I'm excited today. I got a first-time guest here at Crush the Street. His name is Frank Holmes. And so let's just talk here about gold for a little bit. It's making some stealth moves. It's crept up to 1,300 almost here. It's moved back down today. But it's been really one of the best performing asset classes of the year, unless you throw cryptos in there. But now gold is making a move, and I want to make sure the audience is keeping their eyes on this because it's easy to get distracted out there, especially with the way the sector has been over the last few years. So I have on the line Frank Holmes of U.S. Global Investors, the CEO and Chief Investment Officer. And you know what? He's a man who understands the economy, the macro, and what's going on. And his website is usfunds.com. Frank, thanks for coming on the line with me today.
Well, it's great to be with you and sharing my thoughts with your listeners.
Well, again, thanks for coming on. I want to start off here. Let's start off with the economy and then get into gold. But I definitely wanted to start off with that. Bill Gross here says market risk is highest since before the 2008 crisis. And the Fed has been unable to easily hike rates as fast as they've been hoping for. Analysts are calling what we have here in stocks, real estate, and bonds this time around a bubble. And unlike 2008 and 2000, where, two of those, stocks and real estate in 2008 went down, and in 2000 we had just the stock market. Here we have three converging bubbles happening at once. So I'd like to get your thoughts here on, what do you suppose is going on, and are you concerned with the current environment?
Well, I think there's so much to offer, share, Ken, with your readers, but I think to understand these macro themes, that we are big believers that government policies are a precursor to change, and to take the complexity of all the sentiment and the narratives of Trump tweets, etc., it really boils down to a binary model. So the binary is A and B, and we have monetary policy and we have fiscal policy. And monetary, once again, separates into another binary, and it's money supply and it's real interest rates. That is, what will the government entice you to buy their bonds with, subtract the monthly CPI number, and you make a decision, are they attractive, yes or no? That is very important for gold. And then fiscal policy are taxes, corporate taxes and individual taxes and regulations. They're the key factor of understanding fiscal policy and spending. So they're taxing, they're spending. That's how that fiscal policy breaks out. And what has happened since 2008 has been this massive steroids and regulations. It's just the unexpected consequences of layered upon regulations, which has actually started under George W. Bush, and it grew under Obama. And we had 16 years of plaque building up in the heart of free markets, many for good intentions, but not thought through. A lot of them emotional in the way they were created. And so you can't raise interest rates without streamlining regulations. You just can't do it. And so they're in this quandary of trying to stimulate economic activity, and they've relied so much on negative real interest rates and cheap money from the Fed to be able to do that, and they themselves have been increasing their regulations of the system. So I think to me, it's fascinating to see when we look to Europe, they have $1 trillion of non-performing loans on their books, the government, 30% from Italy, 30% for Spain. They have structurally massive unemployment for the youth because of union rules and regulations that dominate their economies. They're not streamlining them. And it's just, you can easily see every time that some factor of the economy has been streamlined, you get this huge explosion in growth. And I'll give you a simple one, is tourism. So what the Spaniards did 8 years ago is they made it easier for Chinese to get into Europe. So the process of getting your visa, passport, was so much faster going through the Spanish embassy in Beijing than it was going through the German or the French or the Italian, etc. So what happens, luxury goods jumped 25% in Spain from Chinese tourists, and they never went to Paris, and Paris was minus 2%. So immediately the Brits changed their policies to make it easier for Chinese tourism, and quietly America allows a 10-year tourist visa for Chinese. Well, if you go to New York and the New York Stock Exchange, you'll see that 20% of the people in front taking photographs are Chinese tourists. They're dominating. And I was in Vegas a couple of weeks ago. They said 20% of the tourists there were Chinese tourists. Property real estate along the West Coast is picked up dramatically by Chinese tourists buying property in America. So that's a fiscal policy streamlining, but we've not had it with these other rules that basically have also impacted the number of public companies, which have had. I wrote about that about 3 weeks ago. So I think we're going to live with low interest rates until there's fiscal reform. And so there are great opportunities when you understand that thesis.
So I guess, what are your thoughts on them actually raising rates? You alluded to it there right at the end. You think we're going to live with low interest rates. And I read something interesting. It said, and I saw the statistic, it says the historical evidence is overwhelming. In the past 100 years, 16 out of the 19 rate hike cycles were followed by recessions. And only in 3 cases turned out to be exceptions to the rules. And I guess what I'm wondering is, can the economy afford to go into a recession at this current time? It seems like we've exhausted every effort to keep us from going into a recession for all of these years. And here we are potentially going into a recession with no ammo to deploy to combat it.
Well, I don't think we're going to go into this big, massive recession like you had in '08, because that recession, like all other ones, were predominantly on massive debt, leverage. And the government are the ones that dictated and allowed brokers to leverage their balance sheets 33-1. You and I didn't do that. It had to be government approved. And when the government turned around and reversed that, that caused this problem. FASB 157, which is called mark-to-market, the implementation of that which came out in the beginning of 2008, saw Bear Stearns go bankrupt from it. And then you saw one factor after another. Almost every major crash in the economy, going back hundreds of years, is leverage. So is this economy right across the board leverage? No, nothing like before. What you do have is the car loans is the concern for being leveraged, but the overall housing is not. The banks aren't. There's so many regs and rules that prevent that. So I don't see that. Do I see stagnant growth? Yes, I see that, and that's why strong dividend-paying stocks, companies buying back their stock, they're outperforming. The government to stimulate economic activity like today. If you look at the 2-year government bond and you look at the 5-year government bond and the 10-year government bond, and you deduct the CPI number for last month of 2.2, along all those time periods, you have negative rates of return. So why would you buy those government bonds? You can go buy dividend-paying stocks higher than a 2-year government bond with positive rates of return and growth. You see that every time when you have negative interest rates like this, gold does well. So there are good pockets of opportunity when you understand this scenario.
Well, you brought up gold, and I definitely want to talk about that here. And gold has been breaking out, hitting some key technical levels. I know this week it was above the 200-week moving average. And we have some geopolitical things happening. Saudi Arabia and a few other Middle East nations have cut ties with Qatar after accusing that small country of promoting terrorism. And of course, this situation reminds the marketplace of high potential for conflict in the Middle East and just why gold is a safe haven in general. So let's get your thoughts here on where we are with gold.
Well, if you go back in the history books, those type of fears are short. They give a story to gold. They're really not important if you're trying to make money in a secular move in gold. It's understanding negative real interest rates and understanding the demand for the love trade from China and India, which India is affectionately known as 40% of the world's population, and they continue to be strong consumers of gold that gets put away and worn as jewelry or it goes into a safety deposit box. So for us in our world, it's negative real interest rates, and it is the most predictive factor on price of gold movement. So do you think the economy can handle rates rising here? No. So then how are you going to make money? You see immediately gold starts responding. And I think the great opportunity right now is gold stocks. The GDXJ, which is the ETF for small cap gold stocks, was such a raving success that they garnered most of the fund flows last year at $5 billion. And all of a sudden they started owning more than 20% of 20 junior gold stocks from Australia to Canada, and they started blowing them all out. And the last big blowout is June the 16th this year, in a couple of weeks, and it's been so disruptive because the price of gold has been rising, and the gold stocks were rising faster, and now they're lagging. They've been pulverized, and there's fantastic buys where these stocks are off 30, 40%, and the price of gold is up, and they're having record free cash flow, record growth in revenue. When I say this, Ken, I like to look at the revenue for the last quarter over the past 4 quarters, and is their production profile stable? That means that if rising gold prices and done any financings, that stock will gravitate to higher prices. So Klondex is a classic. It's off almost 50% from its highs, but record numbers. And this quarter, again, everything's steady Eddie. It'll have fantastic numbers. And so I think that some of these gold stocks are positioned for listeners and readers to be able to buy things on sale by the end of June. Gold trades through 1,300. These stocks explode on the upside.
Well, I'm looking actually at a chart here. We'll make sure we have it on the screen and write down the time here, 12 minutes. I'm looking at this chart, and I see at 1940s, the bull market for these gold stocks was spectacular. 1960s, spectacular bull market. 1970s, spectacular. 2008 to 2011, a big one. And I'm looking at what we've started here in January of 2016. We saw a big move in gold stocks, but it's still nothing compared to what we've seen historically. So, what was what we saw in 2016? Was that a fake move, or is that just part of the way gold trades or gold stocks trade?
Well, I think that a lot of gold stocks had to go through, the companies had been so dilutive in financings for growth that they lost the rule of return on invested capital discipline. And after the big correction, a lot of them come back into that discipline. And we saw them start to explode last year. And then this year, as I mentioned, the GDXJ and all those changes has had a very demonstrative effect negatively on the valuations of these gold stocks. So it has nothing to do with fundamental values. It has to do with liquidity driven by ETFs. They are not smart beta. They're just market cap. And until they're sold their positions out, Ken, then these stocks are just got a headwind in front of them. But as I said earlier, June 16th is the final date for how many shares are selling of a whole list of names, and they'll be dumped, and there'll be fantastic buys.
And then as far as price goes, I almost feel like people have been what feels like burned in the gold sector. As far as, investors, people have been buying since gold was 1900, and it's down. It's not moving the way everyone was hoping it would move. And I almost feel like people aren't going to start paying attention to it largely until we really see gold go into the $1,400, $1,500 range, until people kind of start to get some confidence in it. Any thoughts on that?
Yeah, there's no doubt people need the confidence. I think that's very, very important. And I think it's confidence in the president too. So it's at the beginning of the year, there's huge confidence in him, and we'll see how long it lasts.
And then the confidence in the president would actually put pressure on gold, right? Because that's what we saw following the election, at least up until January, and then January, that's when gold started to rise.
Yeah, I think there's a sentiment that drives markets too, and sentiment to basically drive the emotions of confidence or feeling safe. And the important part is to feel safe. But I guess coming back, it's well documented with all the quant funds that the alpha creation is small cap stocks. The only thing is that small cap stocks have greater volatility. And do investors recognize this is where the opportunities are? Can you stomach the volatility, and can you use volatility to your favor? Can you buy them when they correct, like Netflix had a huge run up and then fell over and then fell 50% and then surged right back to all-time highs? Can you stomach those things? And I think that's the most important psychological, forget the noise of the president as much as what can you stomach in the volatility of these stocks. But I'm a big believer that if you can look at companies where the revenue for the last quarter is above the past 4 quarters, and where the cash flow for the last quarter is above the average of the past 4 quarters, then stay long. And on the volatility, they correct, you buy them. Because those stocks historically go to higher highs.
All right, Frank. Well, hey, I appreciate your knowledge and coming on the show with me today. If people want to learn more about what you're doing, the research that you're putting out, where would they go? And tell everyone more about what they'll find.
Well, go to our website, usfunds.com. It's pretty easy, usfunds.com. And I recommend you sign up for what's called the Investor Alert. It's published every Friday by the money management team on their thoughts of the world, my thoughts from traveling all over the world, and historical data that we like to look at. We've won the most awards in the mutual fund world as providing people with a timely content. It's a game film analysis of 3 sentences for strengths and weaknesses of the past week, and what could be the opportunities and threats for next week, what data point could be. So I think that's helpful. And we have some great clips there, one about gold. It's a 4-minute video clip on gold, and another one on the airline industry, explaining the JETS ETF. And I think this is very important for investors. And the last is what's called Managing Expectations. It's a set of essays I've written on people to understand the DNA of volatility, that different asset classes have different DNAs of volatility over 1 week, 1 month, 1 quarter, 1 year. And it's how do you manage your expectation for yourself is managing that volatility when you know the math. And there's a 70% probability this math just keeps reoccurring and reoccurring and reoccurring. And when you know that, you actually don't show up in Chicago in December in shorts and flip-flops, and you're dressed appropriately for the weather. And vice versa, when you come to Texas, you dress for the weather, and you